Good evening, everyone. My name is Huda Abdelhai, and I am the head of the CSR Summit Series from Informa. A very warm welcome to everyone who joined us today for the webinar. I just wanted to, before we start, I just wanted to quickly talk about the CSR Summit Series. We here at Informa have been managing the CSR Summit Series for around 12 years here in the region, and we produce CSR and sustainability events across the region, as well as manage a CSR blog, which is csrpulse.com. Later this year, we've actually finished several successful events this year in the CSR Summit, including CSR events and sustainability events in Lebanon and Dubai, and looking forward to the CSR Oman and Saudi and Qatar later this year. All these dates will be on our website. Now, without any further ado, today's topic for the webinar, moving from PR-driven CSR to strategic aligned social investment. Obviously, as we all know now, there is a huge drive towards sustainable development in organizations and moving away from the concept of short-term CSR or PR-driven CSR towards sustainable development. So this is going to be a very interesting topic, and our presenter for the webinar today is Claire Woodcraft Scott, who is the CEO of Emets Foundation for Youth Development, and is responsible for driving its vision of supporting youth development in the country. She brings over 20 years of experience working in the field of sustainable development in the Middle East and Africa as a development practitioner, a journalist, and a corporate executive specializing in sustainability, social investment, and reputation management. I'm going to now turn it over to Claire to take over the webinar. Thank you very much.
Good afternoon, everybody. Thank you, Huda, for the introduction. Good afternoon, good evening, good morning, depending on where you are. Delighted to have everybody joining us, and thank you to Informer for inviting me to be here today. As Huda said, the topic that I'd like to discuss is moving from traditional PR-driven CSR to a more strategic, aligned sustainability or social investment agenda. And as we go through, we can talk a little bit about what that means. Just to state from the outset that we're very happy to take any questions as we go along. Your questions will show up on our screen, so don't feel obliged to wait till the end. We're very happy to take questions on an interactive basis. And indeed, we'd like this to be as interactive as possible. So I will be speaking for around 30 to 40 minutes pending questions, but we will also have time at the end for a broader interactive debate. So just a little bit around my background. I worked, first of all, in the development sector, working with various NGOs and developmental organizations. And then, as Huda said, I moved into writing a lot about socioeconomic development as a journalist, and then working in the corporate sector, looking at how businesses can deploy their CSR or social investment capital to create sustainable socioeconomic outcomes. So I like to think that I've seen this sector from various perspectives, both from the traditional developmental perspective and from the perhaps more recent approach of corporate sustainability agenda. I think sometimes the language in this space can be confusing, but for me, I prefer to talk about sustainability or even social investment rather than CSR, and we'll talk a little bit more about that later. But essentially, for anybody who's coming into this subject, what we're discussing is non-commercial finance of development. So this could be donor funding, it could be philanthropic capital, it could be corporate capital that is being deployed in a social fashion. That's really what we're talking about here. Now, back in the day, once upon a time, as they might say, development sustainable development, creating socioeconomic value was very much seen as the remit of developmental agencies. So organizations such as the World Bank, such as the IMF, the UNDP, even foundations and NGOs, was very much seen that if you are talking about job creation or poverty reduction or improving education or improving healthcare or reducing poverty, that all of those areas were really things that the traditional development community was responsible for. And it was actually quite strange to find the business community or the corporate community engaging in that space. And indeed, had you asked some NGOs or developmental actors 10 or 20 years ago if they would consider partnering with the corporate, probably the majority of them would have said no. Now, since the millennium and since, the last 10 years or so, I think we've seen a real shift whereby there has been a recognition that delivering social value is difficult and the traditional developmental players cannot do it alone. And we've really started to see a shift towards business models and towards business playing a role in terms of delivering on social value. So if we look, moving on to the next slide, as to why businesses have been engaged and why they've been important. In the early 21st century, there was a conversation about business as a driver of innovation, but also a driver of progress and also a driver of prosperity at scale. You'll see here on the slide a quote from Professor Michael Porter of Harvard Business School. And of course, he and Mark Kramer, his colleague, were the authors of the shared value concept, which many of you have probably already looked at and heard of. And I think it was really in the early 21st century that we started to see this connection, whereby people were saying that delivering social value is so difficult that development actors cannot do it alone. We were struggling to deliver on the Millennium Development Goals, and people started to realize that we needed a hybrid model, that it was too simplistic to expect a traditional developmental community to deliver on sustainable socioeconomic development, that we had to look at businesses. What is the role of business? And we started to see a huge growth in partnerships between business and the traditional NGO sector, many international NGOs suddenly creating strategic links with corporates. We also saw many of the bilateral development agencies, so organizations such as the UK's DFID or even the US's USAID, Canada's CEDAR, various other bilateral and indeed multilateral agencies partnering with corporates because they realize that not only do they have additional capital to deploy towards development, but that in many cases they also have expertise and technical input that can allow socioeconomic development to progress better, for us to do a better job collectively at resolving some of the world's biggest social challenges. What many organizations, I think Rockefeller was the founder of this idea, call wicked problems. So many socioeconomic issues that we look at, from job creation to improving education to reducing poverty to impacting on healthcare, are problems that exist at scale, that impact millions of people. And hence the idea that businesses, who are often particularly good at creating value at scale, had a lot to offer, and that it was too short-sighted to assume that developmental actors had to act alone. I think this is really where we started to see the principles of business coming into play. If we look at this slide, learning from business, what was it exactly that made business and corporates so interesting to developmental actors? Well, this issue of scale, I think, was particularly important. So private sector world and commercial organizations are always looking at scale, looking at economies of scale. How can we create more products and services? How can we create more value at less cost? And many successful organizations, including some of the companies we saw in the earlier slide, were extremely good at doing that, and hence creating global conglomerates that weren't just sitting at the level of one village or one town or one city or even one country. They were successful at creating products and services and brand and infrastructure and outreach and marketing and supply chains that were truly global. Now, why is that important? Well, if you look at some of these principles here, why it's important is because they work. They were creating positive commercial value. They were growing their business year in, year out with more products, more services, stronger brands. Now, this had a real resonance for the development community. When you're looking at socioeconomic developmental challenges, what you want to do is create solutions at scale. If we're looking at resolving issues around poverty or job creation or education, these are not issues that can be solved at the level of one community. They are issues that need solutions at scale. So we see that the business sector was able to look at the market, understand what the market wants, create products and services that are financially viable, and deploy more than just money, deploy technical expertise and money whereby they can create value. Now, initially, we're talking creating commercial value at scale that you can measure and that is cost effective. Now, those principles in the traditional development community weren't necessarily of a high priority historically, but increasingly today we see the same language, the same lexicon deployed both inside the development community, inside NGOs, inside foundations, and inside the business world. I think there's a real coming together now, this hybrid model whereby we take commercial principles of creating solutions that are sustainable and scalable at scale, that are financially viable, but to create social value and not commercial value. So to create jobs, to create positive healthcare, to create educational outcomes. And all of that by managing risk. This is what businesses are particularly good at, managing risk, understanding where the opportunities lie, understanding how to deploy their capital, understanding what potentially works and what doesn't. So I think in today's world, this is where the opportunity lies for CSR or sustainability, is really about deploying the same principles and the same tested solutions to creating social value. And now, why do we need to do this now? Why should CSR change now? Well, first of all, I think there is currently, with the digital revolution, an exponential speed of change. Social problems are often systemic, and despite Millennium Development Goals, we still face global socioeconomic issues around income inequality, around access to healthcare, around access to education, and perhaps most notably now, jobs. So with this exponential of speed of change that the digital revolution has brought us, we need to be thinking more strategically, not about simply how can CSR protect our brand and grow our brand, but about how we as an organization can fundamentally contribute systemically to the way the world works. And I particularly like the work of Volans, as you'll see on the quote on the slide now. Volans is a UK-based think tank founded and run by John Elkington himself, a great guru in this space. And they talk about how sustainability, if we talk about sustainability rather than CSR, is, and I quote, about the fundamental intergenerational task of winding down the dysfunctional economic and business models of the 19th and 20th centuries and the evolutions of new ones that are fit for a human population headed towards 9 billion people living on a small planet already in ecological overshoot. So it's a bit of a mouthful as a quote, but I think it wonderfully captures many aspects of why companies should be looking to be more strategic with their CSR and why now. So first look at the intergenerational point. So we need to be looking now at what are we leaving behind for next generations. We already see a lot of analysis suggesting that Gen Y, Generation Y, young people in the 21st century may not be able to expect the same quality of life as their ancestors, as their parents, which is quite shocking when we assume that progress is a continuum. He talks about winding down of dysfunctional economic and business models. There is a lot of discussion now about revisiting the very essence of capitalism. Can we really support a model that is purely shareholder driven, that is short-term driven? And also about the reality of the planet. We're going to be heading towards 9 billion people living on one single planet that has finite resources. And much analysis and much research, and certainly climate change experts will tell us that we are already in ecological overshoot. So we are already using our natural resources in a manner that is simply not sustainable. So I think in this quote, it gives us a justification as to why CSR needs to be more strategic, and why perhaps it might be time for us to start talking about underlying systemic sustainability inside an organization, not just a short-term CSR project that can contribute to short-term branding, but a fundamental rethink of the way companies do business and how they manage their business models. Essentially, what we're talking about is a mindset. How do we make sure that businesses, that corporations can do two things really well? One is to engage all of their stakeholders and not just the immediacy of their shareholders or their investors or their clients, but all of their stakeholders. Wherever you have negative externalities as a corporate, and by negative externalities, we simply mean a negative impact, be it on the environment, be it on labor rights, be it on human rights, be it on systems, on government systems, on governance issues. How can we manage those so there are no negative externalities? And how can we make sure that companies are managing their non-technical risks? So not just managing the immediate technical risks they face from a financial perspective or from a technology perspective, but managing those intangible risks such as fence line communities or potential negativity within parts of the population that are being negatively impacted by that company's business model. It's really about having a much more holistic mindset, not just building reputation and brand through PR, but actually integrating these concepts of systemic positive change into the business model, managing non-technical risk and managing the entirety of our stakeholder base. Now, again, to cite Volans, they did some very interesting work called the Future Quotient, FQ, which is a way of measuring your sustainability intelligence, a bit like measuring IQ or EQ, but measuring it FQ. And they deconstructed the mindset that they felt was relevant for companies to be truly sustainable. And they came up with the 7 C's and 5 dimensions of FQ leadership. Essentially, what you see on the screen here is what Volans has defined as a critical mindset if organizations are going to be successful in creating a real sustainability agenda and in moving away from short-term PR-driven CSR to a much more comprehensive social investment. So you see, for example, curious, challenging, collaborative. Let's take those 3. So challenging, it's not easy. It's not easy to think about the entirety of your risks and the entirety of your stakeholder base. But if you only focus on the immediate obvious ones, your longevity may come into question. Companies need to be looking at the long term, looking at 10, 20, 30-year planning horizons and not simply for the next quarter's financial reporting. There needs to be collaboration. We talked about this earlier, but we can see there are strong partnerships now driven between the third sector, between NGOs and businesses. Smart, progressive companies realize they can't deliver social change alone, and the development community realizes that they cannot deliver social change alone. So we're starting to see a change in the language. We hear a lot more about public-private partnerships within various developmental forums. We see the idea of cross-generational, intergenerational, where we're saying again that it's no good to just simply look at the current generation. What legacies are we creating for future generations, and how do we factor that into today's business planning, in today's corporate model? And how do we stay culturally connected? Are we really making sure that we understand the diversity of our stakeholders and don't simply get influenced by those who have an immediate connection to the way we think, to the same people from the same backgrounds, from the same educational system? We see this here in the UAE, that there is huge cultural diversity here. Without integrating cultural diversity and connectivity into the business model, it's difficult for us to understand the entirety of our stakeholder base. And I think the 5 dimensions of future quotient leadership are particularly interesting. And I believe they're actually common sense. So what these 5 principles are simply saying is when you're developing your business strategy, if you integrate these principles into your business strategy, you will inevitably end up being more sustainable. So are you moving from incremental development to long-term systemic value creation? Are you looking from a more narrower stakeholder remit to a much wider one? So not just your shareholders, your clients, but who actually is your business impacting? Are we going from a shallower PR-driven CSR perspective to looking much more fundamentally at things like supply chains? Most companies' impact is through their supply chain, especially large organizations that are operating in a global framework. They have a tremendous ability to impact jobs, lives, livelihoods through the way they source goods and services from local communities. And are we becoming more ambitious? Going back to Michael Porter's concepts around shared value, perhaps by creating positive social value, we can also drive innovation inside our organization. And why only think about the next quarter or the next 2 years? Surely if we're thinking longer term, the next 5, 20, 50 years, we are likely to have a more comprehensive and deeper strategy that will give us longevity. So I developed a very simple maxim for looking at how to apply these kinds of principles to existing social investment, CSR portfolios. And I think these principles apply not only to CSR or sustainability, but they actually also apply to philanthropy more broadly and to any area where organizations are trying to create social change at scale and in a sustainable manner. So here's just an easy way to remember it is ATM. Let's look at the letters. So alignment. Too much in the past, in traditional CSR models, we saw companies that have a completely misaligned agenda with their business model. So for example, we might see a company focused on pharmaceuticals that is actually looking to develop sports programs for children. Now, there's nothing wrong with either of those areas, but clearly there is a misalignment when your core competencies is around pharmaceuticals and science and technology and innovation, and then looking at sporting activities of local educational establishments. For example, when we look at financial sector, often investing in perhaps areas that have nothing to do with finance, these are clearly missed opportunities. What we see from the next slide is that the more companies are investing in an area that aligns with their business, that aligns with their competences, with their expertise, that allows them to provide not just money, but also technical input, the more they look at it as a long-term issue, the higher the impact. This can be seen across the board if you look at banks that are increasingly investing in areas such as financial literacy. If you look at pharmaceutical companies now increasingly investing in traditional community healthcare. If you look at technology companies investing in helping communities to get access, connectivity to the digital revolution, that's a much more effective way of being able to create value. So we're starting to see some questions come through here already. I have one from Enas asking about how can, I assume we mean this can be implemented in the healthcare sector. Well, I think the healthcare sector is already an example. So I always worry where I see healthcare companies creating CSR or social investment that around areas that have nothing to do with health. However, we have some good examples here in the UAE. We see Daman, for example, which is a healthcare insurance company, now looking systematically at creating CSR programs that are connected to the same area, to healthcare. So starting to encourage young people to get interested in health, starting to look at how communities can raise awareness of health issues, and really working at the level of the community beyond just their traditional client base, but deploying their own technical capabilities to create systemic impact, to create social value in addition to the commercial value they already create. So a company like Daman is a great example of a company that's really pioneering in that area, creating an aligned portfolio and creating a long-term systemic approach. So they are not dipping in and out of random community areas. They're focused on something that is critical to their own business. which does two things. One, it allows them to provide investment and technical input. But two, in the main, it means they will stick at it. So they're not going to dabble in healthcare. They're going to systematically go at it until they can see real social returns. We have another question about applying this to a group of companies, to investments or manufacturing. Again, you would need to look at the underlying company strategy. I actually personally believe that we won't be talking about a sustainability agenda in 10 years' time. We'll simply be talking about business strategy, but managing all of the negative externalities. So if you were to take a large conglomerate that is working across the board, and we see many of those in the region that might be working in real estate, healthcare, insurance, banking, we see many of those. So how do you deal with that? How do you choose the area for CSR when you're looking at an organization like that? Very simply, you go back to the commercial strategy. You look at the underlying commercial strategy and you identify two things. One, what's the core stakeholder base that we are impacting? Who are our key stakeholders? Two, what are the key non-technical risks that we face? Once you are able to aggregate those two things and figure out who beyond the immediate stakeholders, such as investors, clients, are we impacting, you will already start to understand the impact of your supply chain. So for example, you might be a retail organization that you think that we're only focused on the customers that come into our mall, that come into our shops and buy from us. They are our key stakeholders. You might find, however, that through your supply chains, there are manufacturing outlets that are polluting the environment in fragile ecosystems in the Middle East. Now, unless you sit down and do a proper stakeholder mapping exercise, you might never know that. If you don't know that, you might not know that there will be potential resistance to your brand from those non-immediate stakeholders. So I think whatever your business model, you first need to understand who are the stakeholders that you are most impacting and how are you impacting? What are the risks that you're creating through your operations? Now, of course, it's much easier to do it if you do it through a company that's focused on one sector rather than a broad-based conglomerate. But the principles apply in either case, that we need to be looking at the entirety of our stakeholder base and the entirety of the non-technical risks that the organization faces. If you look at some of the big oil and gas companies now operating globally who have been doing this for a long time because they create more obvious and perhaps more high impact negative externalities, they are now not even talking about sustainability agenda. They're talking about non-technical risk. How do you manage non-technical risk? And by the way, that's also how you get it onto the radar screen of your CEO. We have another question about the implementation in a high manpower turnover industry, such as construction projects. Well, I think construction is very much going down the same route as the extractive industries. So I think the construction sector is learning a lot from oil and gas companies, particularly in this region, about what I just said, managing the entirety of your stakeholder base. So again, if you're a construction company, go back and look at the entirety of your stakeholder base. Clearly, you have your clients, your investors, your shareholders, but you also have massive supply chains. You're sourcing inputs from regionally, potentially all over the world. You're sourcing labor regionally and from all over the world. And you have stakeholders around that. So start to figure out what are the non-technical risks that you face? Who exactly is in your supply chain? Who is impacted by your operations other than your immediate stakeholders? And then start to mitigate those risks. But that fundamental underlying mapping process is where you start. And generally, once you undertake that process, you will discover a whole array of areas that might not even have been on your radar screen in the past. You might discover communities that are impacted in ways that you might not have predicted. It's really important that you deconstruct your business model on those two levels. One, the entirety of your stakeholder base. Two, the entirety of your technical risk. So we've talked a lot about alignment there and why it's important that you align your social investment with your business model. Let's talk about the T area now, the transparency piece and why that's important. So I actually believe transparency is fundamental to any sustainability strategy for any organization, because quite simply we live in the 21st century in a digital world. So back in the day, companies could hide negative externalities, they could hide bad products and bad services. And they might not have had a level of connectivity between their clients that the bad products or services would have impacted their brand. So I could have produced a poor quality product that was only distributed in one country and only people in that one country knew about, and not impact my global brand or my reputation. But we all know those days are over now. There is a huge amount of online discussion around product review. You've got things like TripAdvisor now. You look at any of these online platforms where you have a level of exposure, reputational exposure, that is global and immediate. And we all know the brands can be crashed overnight now through that kind of level of exposure. So anything that organizations do now needs to be transparent, because there's nowhere to hide. So if we look at what we mean by transparency when it comes to CSR, social investment, some very simple things. So I talk to many organizations and I ask them, how do you know if your CSR portfolio is impactful? How do you know if your social investment has really delivered value that is measurable, sustainable, and scalable? And most of them will tell you, I don't know. My company doesn't ask me to measure that. And it's rather strange that in commercial organizations who systematically measure their commercial output and the cost of delivering it and the value it created and the economies of scale that exist, when it comes to their CSR or their social investment portfolio, they don't apply the same principles. And that, we believe, is a rather strange disconnect. So what I'm suggesting here is that we get much more honest and open about what works and what doesn't. If you started an initiative that is not aligned with your fundamental business model, and whilst it was a particular pet interest of one of your senior executives and it was a nice to have, did it actually create outcomes? Did it create results that were sustainable? You may have decided to invest in a capital project like developing a school or a hospital or some bricks and mortar project, but have you actually thought through how that project is going to be sustained over the long term? How is the community that you're supporting going to finance that project over the long term if your company decides to divest and move on to somewhere else? So we need to ask ourselves much more stringent questions about the focus of our CSR, of our social investment. Is there really the competency from our side to manage this CSR program? If I'm building schools or hospitals, do I really know anything about schools or hospitals? Do I have expertise inside my team to be delivering on that kind of output? More importantly, is there a demand for that? Is this market-based? Too often we drive CSR programs by surmising what our communities want rather than actually asking them. Again, it's hugely important to talk to your stakeholders and ask them, what can we do for you? How can we help you? How can we create value? And then also challenge that. Have the transparency to challenge that. So if your stakeholders say, please build us schools and hospitals, it doesn't mean that you have to adopt a bricks and mortar approach. It's about having a debate and a discussion. Challenge the community. Is that not the role of government? Challenge the government. Tell them this is not necessarily our expertise. However, we can help you in a different area where we do have technical capability. So it's really about having an open and honest conversation with your stakeholders about what they need, about what you can feasibly deliver, about what you can commit to over the long term, about what you understand. Again, going back to my example of a pharmaceutical company, clearly a pharmaceutical company would have great expertise around science and technology and innovation and healthcare. So why not ask the pharmaceutical company to focus its social investment portfolio in those areas rather than building bricks and mortar? And again, if we look at the business sector, how we run our commercial operations should be no different in terms of the principles from our social operations. So if I'm looking at my commercial operations, I want to know that my products and services are going to be viable over the long term, that they are going to be scalable and measurable and sustainable, that I can continue to produce these products and services for the next 10, 15, 20 years. Why wouldn't I apply the same principles to my social outcomes. So if I'm going to invest in healthcare, I want to make sure I can create real value in healthcare and that it can be measurable and sustainable. I want to be able to measure it. It's not good enough to say I have 10 projects in this area and I spent $10 million on that particular social investment project. You need to be able to articulate how much social value did you create. So let's look finally at measuring. What do we mean by measuring? So first of all, I think it's hugely important to keep it simple. There are some great international platforms now where we can look at reporting for sustainability. And going back to my earlier point, I think at some point we will have a convergence of traditional commercial reporting and sustainability reporting. So you have now global platforms like GRI that are being factored into sustainability reports. Ultimately, I'd like to see a day where the sustainability report is just the business report, and it's capturing everything from the fundamental supply chain to our social impact, to how we engage with stakeholders, to our internal metrics. There is a one-stop shop for how any organization integrates with the planet at large, using all the metrics that we are now, all the ESG metrics that we're all becoming familiar with. So you have a very comprehensive approach to measuring and reporting on sustainability. And when it comes to our social engagement, are we having scale of impact? I mean, it's wonderful if a large conglomerate can work with a particular village and create value. But when we're talking about wicked problems, when we're talking about high levels of unemployment, about access to education, about access to healthcare, about poverty reduction, we cannot be talking about hundreds or even thousands. When we're talking about a planet of 6 to 9 billion people and millions of people still under the poverty line, we need to be talking about scale. And this is where companies are particularly capable of creating scale. So that's the first thing. Are we really impacting at scale? Second thing is permanent impact. We often see organizations going in and creating short-term projects that have an amazing impact for 12 or 18 months. But when you go back 5 years later, have they really created a systemic approach? Have we built capacity in that community to continue this initiative with or without corporate support? Are they financially sustainable? So have we made a one-time capital contribution without thinking about how is the community going to continue to finance this initiative over the longer term? Have we created the technical competencies to continue this initiative over the longer term? So really going back to the Volens report, it's about long-term thinking. It's not about rushing into an immediate community and throwing in solutions that we believe can have an immediate reputational or PR impact. It's about thinking about over the longer term, can we create real measurable social value? So looking now at some of the latest thinking, many of you may be aware of the idea of shared value, which I think is taking things to another level around how we come at CSR. So here we have a quote from Michael Porter and Mark Kramer, who are the founders of the FSG, which is a consulting firm in the US that works very closely with foundations and with corporates around social value creation. And they make the point that prevailing approaches to CSR are so fragmented and disconnected from business strategy as to obscure the greatest opportunities for companies to benefit society. If corporations were to use the same frameworks that guide their business, they would discover that CSR can be a source of opportunity, innovation, and competitive advantage. So they're essentially saying the same thing, that if we look at integrating sustainability and social investment into the underlying business model, not only can we create a business case, but we can actually drive innovation. So can organizations, by deconstructing their supply chains and looking at the negative externalities of their supply chains, actually come up with new ways of delivering products and services, new ideas around how to produce, how to manufacture their products and services, new ideas of how to engage local communities, small businesses. We hear a lot of now talk about local content. creating local content in our business strategy. In other words, engaging with small suppliers rather than necessarily having global procurement centralized, but looking to support SMEs in the market where the company is operational. And that in and of itself can be a very powerful way of creating jobs, supporting local SMEs and helping them to access supply chain. So I think really what we're saying here again is that short-termism doesn't work. We need to be thinking long-term about how our CSR, our social investment can drive innovation inside the organization and lead to longevity. And I'm just going to skip down 2 slides. So I particularly like this ancient Chinese proverb, which I think reiterates the comment from Porter and Kramer, saying, when the wind blows, there are those that build walls, and then there are those that build windmills. So organizations that know they have to do more around creating social impact, that know they have to do more community engagement, but that don't have the courage and hunker down and think that maybe this will go away and let's just continue business as usual, are not likely to survive in the long term. Those organizations who see these new demands, who see this new level of accountability and connectivity as an opportunity to change and to innovate, are much more likely to both thrive and become leaders in their field. And that may well mean a radical change to the way they do business, even a breakthrough, as our friends at Volans would call it. So fundamental rethinking of the way we do business, beyond business as usual, that's driving new strategy ideas and new products and services. So if we just go back to the earlier slide, we see an example of an organization that has been taking an integrated approach to sustainability. Just bear with us while we look there. So the organization is Marks and Spencer's. So this is a UK-based retail organization that many of you may be familiar with, that has what they call Plan A. Plan A was launched in January 2007, looking at making 100 commitments to achieve in 5 years, subsequently extended to 180 by 2015. Now, they were quite a traditional retail outlet that was actually struggling from a business perspective a few years back. But they took a very progressive approach and said that sustainability for us is not a PR thing, it's not a brand thing. It absolutely hits our entire business model, and it's going to be about everything we do. It's going to be about how we source our products and services. It's going to be about how we engage with suppliers. It's going to be about how we engage with our clients. It's going to be about how we engage with our investors. And every year they present their progress on Plan A, which they call Plan A because they say there is no Plan B. And the people that present the progress are the entirety of their executive committee. So it's not just a CEO or the head of sustainability. It's the people from HR, it's the IT, it's the branding people, it's the marketing people. It's every single element of the organization that has come together to integrate their sustainability plan into their overall business model. So they're looking at how they work with customers, they're looking at climate change, they're looking at reduce waste, closed loop production cycle, the way they source materials, are they sourcing ethically, looking at the growth in ethical consumption, and really taking a very holistic approach to how they manage their business. And I think they are, and by no means have they nailed it yet, but they're making good progress, and they're certainly standing out as an organization that looks at things holistically. Now, moving just briefly and finally to our model at Emets Foundation. So we underwent our own transition, our own breakthrough, we like to think, 3 years ago, where we moved from quite a traditional philanthropic model to one that was based on a business model. It's called venture philanthropy, and it's basically a market-based approach of delivering social value. So we looked at one of the key areas that we felt needed to be addressed. We look at, as philanthropy should, what is the government doing, what is the private sector doing, and how can we pick off the gaps in the middle And we decided that here and indeed globally, youth and youth development is a critical area for us to work in. So we deployed a model called venture philanthropy that isn't about short-term grant making. It isn't about issuing hundreds of checks every year in multiple different sectors and hoping that somehow we create value. It's about being extremely focused. So we went from having hundreds of grants every year to having just one sectoral focus around youth development, from having hundreds of different initiatives to having just 6 core programs that are all run like small businesses. And each one of those core programs is addressing a gap in the market. So for example, we have a program to help young people become more financially literate so they can manage their own personal finance and so they can develop business acumen and become entrepreneurs. Because we felt there wasn't enough being done at a nationwide level. So we've created programs that respond to a particular gap in the market. But then we grow those programs, we incubate them, we test that the solution we have suggested really does work. If we believe it works, then we pilot it. After the pilot, we look to scale it up. And ultimately, we want to be able to spin off each one of those programs as an independent revenue generating enterprise, a social enterprise that is creating social value. It's quite a unique model. There are only a few other foundations in the world that have adopted it, but we believe it's much more impactful than traditional philanthropy. It's much harder, but once you create the value at the end of the day, it's going to be more sustainable than short-term grant making or short-term grant making approach where there's no focus. That's been our new model at Emets Foundation, and what it's forced us to do is fundamentally change our mindset. So from a traditional CSR or philanthropy approach, we are now looking at strategic social investment, where there's a return on our social investment, where we look at cost metrics, we look at economies of scale. Can we create reduce costs but maximize our social impact? So can we create incremental social value with reduced costs, going from multiple activities to being very focused on one particular area, going from short-term projects to long-term partnerships with the private sector, going from this feel-good factor to creating real value add, going from short-term issuing of checks to creating a real tangible technical input that goes beyond money, from short-term subsidization to creating long-term financial viability, and from subsidy dependence to exit. So each one of our programs is run like a small business. Each one has a 5-year business plan. Each one has cost efficiencies tracked year in and year out. And each one of our 6 programs can be aggregated into a single scorecard for us at the end of the year. So we can be held accountable to our board and to our investors, who are, I should say, primarily private sector long-term corporates that have been with us through long-term partnerships. So that's just a brief upshot on how we at Emets Foundation have applied the business principles that I was talking about to our own portfolio and shifted into a very different model. So I think we still have a bit of time left for any questions, any outstanding questions. And I think we have a couple coming up here on the screen, one here around GRI and ISO 26000. I think any of these international standards from ISO to GRI are absolutely important. However, they tend to drive a process. And I'm a firm believer that you have to have a change in your strategy mindset before any amount of process can deliver the outcomes. Sometimes we see organizations that focus first on the process, creating the ISO standards and the ISO implementation, and then try to figure out what their strategy is. Personally, I think that's the wrong way around. I think you need to be really sure of why are you in this? What's your vision? Why are you doing this? And how are you going to deliver it? Why do we need this organization? Once you've got really clear and you're aligned around your vision internally inside the organization, Emets Foundation, we spent a lot of time talking to our teams, to our stakeholders, to our partners, to government, to the private sector to make sure that our business model resonated. Now, a couple of years after our new model has been developed, now we're looking at institutionalizing by looking at EFQM, by looking at GRI, by looking at ISO standards. But I think if you start with the ISO and the GRI it becomes too procedurally driven. I think you need to start with the vision, what you think you can deliver, what's the social value you can create on the back of your commercial value if you're a corporation. And then you use tools like ISO and GRI to institutionalize your mindset. The GRI and ISO are tools. They are not going to create the vision for you. And that's where you get leadership. That's where you need your CEO to own the agenda. You need to engage with all of your stakeholders and really create that mindset and then use the tools to implement it. Another question about examples of non-profit government organizations, non-profitable government, and I'm not sure whether you mean NGOs or quangos or semi-government entities. I mean, if you're talking about traditional NGOs, I think they are also undergoing this shift. So if you look at some of the big international NGOs like the World Wildlife Fund or Oxfam or any of these organizations, you'll find they are very much becoming more focused on their strategy, on long-term planning, on capital deployment, and on partnership with the private sector. And I think that they are certainly deploying many of the principles that I've already talked about. You are starting to see a lot more private sector people go into the traditional NGO sector. But if you're talking about non-profit government entities, yeah, perhaps you can clarify that who you might mean. Governmental healthcare sector. Well, to be honest, both there's another question about governmental healthcare sector. So whether you are, it doesn't really matter what sector you're in. My recommendation, and given this is only a 1 hour conversation, it may sound a little simplistic, is to start with what I just said around the vision. So what is your role? What are the gaps in the market? What are you delivering as a healthcare organization or as a non-profitable government organization? And then deconstruct your stakeholder base, talk to your stakeholders, where are you having negative externalities? And you might have negative externalities even if you're the Ministry of Health. I mean, any organization can have negative externalities. Figure out what they are, which stakeholders they are impacting, and what are the potential risks that emanate from that. And then identify those areas where you can mitigate those risks. So all organizations can do that, irrespective of whether you are a government, a non-government, not-for-profit, for-profit. It really doesn't matter. That's what I think the principles of sustainability that we've been talking about today can apply to any organization, including, we have a question here about automotive trading, and same thing, same principle. So if you're making cars, who are you impacting? So, okay, on the one hand, you're impacting your investors and your immediate clients, but you're also impacting, you have massive supply chains. Who's producing your cars? Where? How are you importing them? What about the car emissions? What about the messaging that you're sending to young people around cars? Why are we using cars? What about hybrid? What about fuel efficiency? Think about your business in a holistic fashion and predict the potential risks of not engaging all of your relevant stakeholders. But again, if you start with the stakeholder mapping and figure out where is the materiality, so where are the key areas that impact your key stakeholders that also potentially create risks for you. So it's about mapping those two areas. I mean, the automotive industry will have plenty of areas, I would think, looking at. Again, emissions, fuel efficiency, client engagement, regulatory issues, looking at using innovation over the long term to create more fuel efficient cars. I mean, I used to work for an oil and gas company, and people don't realize this, but even oil and gas companies are looking at fuel efficiency, at energy efficiency, because gone are the days where you can simply keep promoting your products and service and remain myopic about the negative externalities. We have a few more questions and points here that I will try and touch on. The latest one being the cost of the CSR and the degree of engagement a company is targeting. Yeah, great point. So I think look, this is something we hear. How do you make the business case? So how do you make a business case so that your organization sees CSR not as a cost, but as an opportunity to render its business more sustainable over the long term. And I think there you need to look at what companies like, and I hate to continuously cite them because there are others as well, but companies like Unilever. Unilever, that is a large global conglomerate that has everything from consumer goods to larger scale products and services, is looking at the entirety of its supply chain and saying, how do we manage the negative externalities and how do we innovate on the back of that? And how does that create or impact our bottom line? If you look at the more mature leaders in the market globally, you will see that they are creating value out of their CSR strategy. And they probably don't call it a CSR strategy. They probably call it their sustainability strategy. If you look at Nike, Nike had a massive negative reputational impact back in the 90s when it was accused of exploiting child labor in Asian markets. On the back of that issue, they fundamentally radically changed the way they produce. They engaged around improving labor rights in Southeast Asia. And then they started talking about a closed loop production cycle, where they're saying that any input that we use to manufacture our products has to create zero waste. We have to be able to create a closed loop production cycle. Now, obviously, if you're no longer wasting inputs, you're saving money. So I think it's about taking a long-term perspective, seeing the bigger picture, building a business case. Once you build a business case, your management will come on board. And look at companies like Unilever, like Nike, like Marks and Spencer's, like some of the local ones. I mentioned Daman earlier. Majid Al Futtaim is doing some very interesting stuff in the sustainability space. So look at regional and local examples and see how they have built a business case. I honestly believe that organizations who have an integrated, effective sustainability strategy will be here in 10, 20, 30 years' time. So if that's not a business case, I don't know what. If you're short-termist and you're not managing your non-technical risk and your negative externalities, you may struggle to survive in the 21st century. Just time for perhaps one last question. We have here companies in Saudi Arabia, I think, apply the same principles. I honestly don't believe that the principles are different anywhere. Look at your stakeholder base in Saudi Arabia. There may be distinct stakeholders in Saudi Arabia that may not be relevant to your business in other markets, but the principles are the same. Assess and map your stakeholder base, pull out the non-technical risks, and mitigate them. Doesn't matter which country you're in. And if you look at things like GRI standards, you will find that they are applicable across the board. Sustainability isn't country specific. The principles apply everywhere. Your specific individual stakeholders may be different, but the principles are exactly the same. So I think I'm going to close out there. We had a few other questions around the tools. I think I mentioned that earlier around looking at, ISO, GRI. These are tools, but you need the mindset, you need the strategy, you need the vision, you need the comprehensive stakeholder mapping, and you need to tie it into risk management. That's how you create the business case. That's how you sell it into your board. And ultimately, that's what you need. If you cannot get a CEO or board ownership of your strategy, you need to go back to building blocks. And you need to be briefing your board and your business and your CEO and your shareholders on how not having a sustainability strategy integrated into your business strategy can actually threaten the longevity of your business over the longer term. Going back to Volans, this is what sustainability is all about. It's about managing dysfunctional business models, creating new innovative ones that can help you survive and thrive in the 21st century, and that can create fundamentally new ways, new integrated approaches to delivering products and services in a way that can protect and promote the planet rather than undermine it. So on that note, I think I'm going to close there. Thank you all for listening. The PowerPoint presentation will be available from Informa, and I'm very happy to stay in touch with all of you separately through social media. Thank you for listening, and hope you find it useful.